Good Saturday morning to you, and welcome to On the Mark, along with Mark Pappa. I'm Gary Byron. Mark Pappa is from Financial Resources Group out of Glastonbury. You can find them online at www.f, as in Frank, frplan.com. On there, by the way, there's a link over to YouTube. If you can't get to YouTube on your own, you can just link up with them through frplan.com. And once it brings you to YouTube, you got to check out Mark Pappa's YouTube channel. Simply go to the search field and type in Mark, that's M-A-R-K, it's Mark with a K, Pappa, P-A-P-P-A 5207. And that way, any of the episodes in the past that you may have missed, you can download, you can watch them online. You can also make an appointment with Mark Pappa very easily at 860-657-8380. Again, 860-657-8380. And if you missed any of that, no worries. I'll repeat that at least a couple of more times before this show is over. Mark, great to see you this morning.
Hello, Gary. How are you?
Not too shabby. How about yourself?
I'm doing good. Yeah.
How was your Memorial Day weekend? That was last weekend. Did you have a good time?
Yeah. Well, I did. I promised in the last episode I did a Monday barbecue. Thankfully, we had some sun. Sunday was too cold to pretty much do anything.
I can't. This weather is just horrendous.
Yeah, I'm looking forward and not having to deal with freezing cold weather. My son's playing baseball, and when the wind picks up. Even, we're in June almost there. We're near in June, and
tomorrow
it's cold.
I can't even sit in the shade. I mean, I like the sun beating down on me.
Exactly.
What a difference that makes.
Yeah, but I'm glad to be here.
I'm happy to have you here this morning, as I am every Saturday morning. So let's start with, I want to talk about capital gains a little bit this morning, which can really sting for investors with big gains. What do you think are some unique tax planning strategies that you can recommend for clients facing these capital gains exposures?
Well, there's an awful lot people can do. I decided to do this episode because I'm getting people who are calling me that inherited a home that mom and dad quitclaim deed where they just literally gave the kids the house, and took advantage of the 5-year look back to qualify for Medicaid without realizing that mom and dad bought that house and paid it off in 68 and their cost basis might be, $15,000 or $20,000. And now that house is selling and the beneficiaries of the home, mom could still be in a nursing home. Maybe they need to sell it, pay some bills, whatever. But the whole idea of the quitclaim was the old estate planning way of let's protect the house from the long-term care boogeyman, right? Well, what happens is in that case, you save the house, but if your capital, with the mom and dad's cost was $20,000, you're selling it for $400. You have a $380,000 capital gain. Now, if there's more than one beneficiary, you can split it 2-3 ways. But they're going to be paying a big tax bill, and I've been seeing a lot of that.
What's the threshold? It's over a certain amount is when capital gains kicks in, or?
Well, in this case, it's immediate because they, just for the audience, unless you have a really, really good reason to quitclaim an asset, it's your last resort. Don't do it. There's so many better ways to plan ahead.
But if you take that gain and you invest it in, let's say, another property.
Well, because
are you still hit with it?
In this case, it's a personal residence. So I'm going to talk about that. That's you're on the ball, Gary. You really are. That's what you would call a 1031 exchange. Mm-hmm. Let's say I was a house flipper, or I was buying a house, or I was a real estate investor. It was a commercial property. Then I can qualify for 1031. Assuming, by the way, just a quick disclosure for the regulators, you have to, in certain cases, be what's called an accredited investor for some of the strategies I'm going to talk about today.
Okay.
Accredited means if you're single, you have to make at least $200,000 with the anticipation you're going to make at least $200,000 in the future. And if you're a married couple, it's $300,000. And then, or a net worth over $1 million. And if it's a business or a trust, it has to be worth over at least $5 million in assets. But let me explain what's happening. So in that case, these people are basically getting these big tax bills. Now, some of these folks might also, because let's think about it, their parents gifted that property, might still be working. So they're earning, and they're in the later years of their earnings career. So they're earning, joint income of 150, 200,000, 250, and now you throw a giant capital gains tax on top of that. What do you do, right?
Wow.
Think about what that bill's going to be. Even though it's a long-term gain, they can get hit with, it's probably not going to be the 0, the 15 or the 20% long-term capital gains tax. Plus, they also get hit with which is called the net investment income tax. So, you're looking at I think in Connecticut, it's about 23.5% when you combine federal and state for most people or many people. It could be a little higher depending on what your income is. What people don't understand is that capital gain might be taxed at that lower rate, but it can put all your other earnings, Social Security, all your other income and push you into an even higher bracket. So what is the solution for that? There's a couple things people can do. For those, depending on their appetite, I did one of these for a client. They had a $70,000 gain on a non-investment property. It was a property that actually they had bought for their daughter, their granddaughter. And they bought it for a granddaughter. They never really rented it. They never depreciated it, never deducted anything. But she lived there. And they made about a $70,000 gain on the property.
Nice.
And they learned from the first time they sold the property, they got killed in taxes. So what they did was they called me and I sat down with them. We took that $70,000 gain and we were able to put it in a qualified opportunity zone, what's called a QOZ. And QRZs were created by the 2017 Tax Cuts and Jobs Act. I'm hoping they get extended. Because we're seeing a lot of these QOZs in areas.
Is that like retirement or something? Or?
It's called a qualified opportunity zone. So it's actually, if you invest in a distressed area, one of the examples in this case was student housing in Los Angeles for UCLA. So it was a very, I guess it was a pretty rough area, but they were able to clean up the area by investing in this new building. But they were able to defer, not avoid, but defer that $70,000 capital gain all the way up to December 31st of 2026 without having to pay that taxes. Now, what happens is if hopefully that gets extended, you could defer for 5 years, and then if you want to elect, you could pay the taxes at the end of 5 years. Or what you can do is defer for another 10. And as long as you stay in for another 5 years, then any additional capital gains, let's say they sell that building for a profit, you pay 0. So it's a really good tax strategy for people that are stuck in some of these taxable assets that they didn't anticipate. Now, you're alternatively, you can just pay the tax, be a good patriot and pay the tax.
So how do they help with capital gains, these qualified opportunities?
Well, they basically defer the capital gains. There's a deferral period.
Oh, okay.
And then you don't have to pay. And then if you stay in the project for 10 years, then any gains are not taxed on the way out on your exit.
Listen, that's a compelling option. I guess another term that I've heard is this thing called intangible drilling costs. I don't know what it means. Maybe you can explain what those are and how they even fit into tax planning.
All right. So intangible drilling costs are part of, let's make it this way, oil and gas drilling and development. Oil and gas wells, typically, you get an institutional quality drilling program. A lot of the popular areas. Let's just use the Permian Basin as an example. And they'll partner with some of the majors, your Chevrons, your Mobils, your Exxons, Marathon, all the big players, and they actually are drilling. They're drilling oil. They're drilling wells. When you do that, again at a high level, you have to be an accredited investor again, but you can get up to a 90% immediate tax write-off. So let's say I was going to, I had some cash in the bank and I knew it was just going to be whacked with a capital gain or whatever. Let's say the capital gain was, $90,000. Well, you can put $100,000 in one of these products and get an immediate $90,000 loss to help against your income to help offset those taxes. And it's a pretty cool thing because it does pay a dividend, and I'm not going to quote any numbers because each program is different. But those intangible drilling costs are very, very attractive. Now, keep in mind that typically the well will pump pretty healthily for the first 5 years because of the way they do things in fracking, and then it sort of tapers off. But you get your big tax, you'd get your big tax benefit, and hopefully the dividend gives you at least a return of capital, if not better. So you earn some interest on it.
It sounds a little complex. It can be a little confusing.
It's not. This is not for somebody walking into the bank branch with
I didn't think so.
$25,000. It's again, this is for somebody who is in a pickle, who maybe every year gets hit with big gains, or may want to do one of the other things we use this for is a Roth conversion. Think about it. You're going to take money out of a traditional IRA, and you want to do a Roth conversion. You're going to have to pay tax on that Roth conversion. It might be anywhere between 25 and 30% on that conversion. So if you wanted to convert, a little at a time, you can. But if you needed to convert, you can create yourself a big loss on your tax return to help offset the taxes you're going to pay on that Roth conversion. And then if you want to get really creative, which I'm not going to share with the audience right now, you have to call me for this. There's another way we actually have a product that actually helps you pay the taxes on the conversion.
You said something a moment ago, and I don't know if you need to be a sophisticated investor for this, but you used the term accredited investor. So what qualifies someone to be an accredited investor? And really, what does it even matter?
Well, because this isn't, you definitely have to have a certain level of sophistication, according to the SEC, to be investing in some of these products. It's not like, some people have just enough to live. They have just enough saved, just enough to pay their bills, just enough, and they feel every pinch, right? They when whether their condo fees are going up, the property taxes are going up. Now the big headline over the last 12 months was eggs going up. Those are coming down. But they feel every pinch. Those are not, unfortunately for these people, this isn't for them. But unfortunately, a lot of these people, which is unfortunate, do get caught up in these type of things without, that are just beyond their control. So then you have to get very creative and figure out. Now, some people, if they're not making a lot of money, then the capital gains could be as low as zero, depending on they're single or married. So there's a whole tax bracket for that too. But most people that we're encountering are facing a substantial tax problem that they've never had before. And again, when you combine it with their Social Security, their Medicare,
is it a certain amount of money that you're investing? Is that how you become accredited, or is it SEC involved?
Oh, I apologize. So the actual SEC rule is $200,000 in income if you're single.
Okay.
Net worth of at least $1 million, and then married, you have to have income of $300,000 with the anticipation of earning that again, or $1 million net worth, and that's net of all your real estate, your debt, your mortgage. All that stuff.
Okay, now I got it.
So that, given where we are in the world and the assets, we've had price inflation, wage inflation, but we've also had asset inflation. Let's face it, markets have done very, very well. So it's not uncommon for somebody to have a net worth of $1 million anymore.
All right, so I now I get it. Thank you for clarifying that for me. Let's talk a little bit about real estate, because many people own investment properties and have heard of the 1031 exchanges. Maybe you could explain a little bit about what they are and how they actually provide tax benefits.
Yeah, it's an awesome. So the 1031 exchange, it's done in the institutional world all the time. And in fact, if you remember the headlines, there was talks of actually eliminating the 1031 exchanges for commercial real estate. So that would have caused a collapse, aside from a lot of the other things that went on with the financing of against Donald Trump. A lot of people don't realize when people go to buy a building, you can use the future value of that building as long as it's somewhat realistic. I'm going to buy that building for X, and you're going to tell the bank when I'm done renovating, it's going to be worth Y. That's how real estate finance is done. They'll give you the money for that. And it's the banks. They're not stupid. They're not, well, sometimes they are, but they're going to give you that money. So if something like that had passed, commercial real estate would have been really in trouble. And right now, if you look at, let's say, the public real estate sector, the publicly traded real estate investment trusts are trading near all-time low multiples. There's great opportunities there. And in the private market, they're the ones that are tend to have a little bit more of a problem. But long story short, what happens is if you buy a property at X, so I buy, let's say, use a simple. I buy let's say I buy a 3-family. I pay $300,000 for the 3-family 10 years ago, and now it's appreciated to $500,000. I have a $200,000 gain.
Yeah, nice.
Now, if I sell it and flip out of it, I'm going to pay tax on the $200,000, right? But if I'm somebody who's renting, or I'm looking for real estate, now I might say, well, why don't I just, for simple illustrative purposes only, well, there's a 6-family down the street. Now, as long as that's a commercial property, right, I could take a like-kind exchange. And this is, of course, not to get in the weeds too deep, minus if there's a mortgage, there's all sorts of different rules, minus debt and all that stuff. But let's say I just owned it in cash, and I have 180 days.
You're going to take that $200,000 that you made from the 3-family.
And now I can go buy a property for $500,000 and pay no tax on the $200,000. So that's
how long do you have between transactions?
It's 180 days. So you have 180 days.
From the time that you sell to the time that you buy.
Right. So you have about, right, exactly. So you have to do it within 180 days. And I believe you have to identify a target property. I think it's within 45 days or 90 days or something.
And this is commercial, right?
This is commercial, but commercial is, it could be beach home to beach home if you're renting. It could be rental property to rental property. It could be all sorts of different types of property, as long as it's there for economic. If you're using it as a rental property or using it could be an office space, a strip mall. Again, it's just got to be what they call a like-kind exchange, and as long as it's like to like, they'll accept it. Now, you can't take possession of those funds, by the way. So you can't take possession of the funds. You actually have to go through a third-party exchange. Almost like an agent, like an escrow agent. And then they will hold the funds for you. And then, in your purchase and sale agreement, you have to make sure that you state that it's going to be a 1031 so that the IRS can't come back and audit. If they do come back and audit you, they know that it's there. So it's, but it does, like I said, on the radio, I can't get into all the details.
No.
I want to talk to you about it at all.
Folks, you're listening to On the Mark along with Mark Pappa. I'm Gary Byron. Mark is from Financial Resources Group out of Glastonbury. You can find them online at www.frplan.com. And by the way, if you'd like to sit down and just talk to Mark, there's never any obligation. Ask for his checklist. Get a $100 gift card. Just sit down. You never know what he can offer you that you're not getting elsewhere. 860-657-8380, and I'll repeat it more more towards the end of the show. I mean, look, Mark, that's a fantastic way to keep wealth working. Now, I hear you're launching a new website focused on IRC 351. Tell us about that and how it actually helps people or maybe even your clients diversify and even minimize these capital gains taxes.
Yeah. This has to be one of the most, I'd say, exciting opportunities I've seen in my career. Mm-hmm. And again, as somebody who does tax returns, and I just sit there and I want, by the way, I will be doing tax planning going forward, and then only people who are Financial Resources Group advisory clients will be people that I will be willing to do taxes for. This was a very daunting season, and I'd rather be doing advisory, not data entry. I'm way beyond that, okay? And I'm just done of contorting my brain and bending my body and stressing myself out. So it just isn't worth it anymore. But I do have a great group of people that will be processing those returns. I'll be reviewing them. But let me tell you about IRC 351. This is a really exciting opportunity. It's been around for many decades. I think it was, I forget the exact date. I didn't write it down, but I think it's 1954. But essentially, it's allowed to allow a transfer of property, stocks and securities. Put it this way. I'm doing this not for businesses or corporations, but let me just read what it is. So it's under IRC code. It allows for tax-free transfer of property to a corporation, including a newly exchange-traded fund or ETF. So exchange-traded funds is what you see, in the marketplace. Your Your Vanguards, your Fidelities, your Wisdom Trees, there's all sorts of what they call exchange-traded funds. They are the competitor to mutual funds and what people are migrating to now for their tax efficiency, for their lower costs, for their diversification. It's just a much more interesting product. It's newer technology. So to make it simple, IRC 351, what they allow you to do is take a portfolio that has a tax trap. Now, what's a tax trap? Let's say I have a big brokerage account with $1 million. Okay, doesn't have to be $1 million.
Okay.
And I'm all out of when you talk about tax planning to many advisors out there, we're going to do our tax loss harvesting at the end of the year. We're going to try and make these, shuffle the deck on the Titanic to lower your tax bill every year. We have some accumulated losses that we can use against the gains. I mean, that's what actually pretty good advisors do. Mm-hmm. But that's the extent of it. It doesn't go beyond that. The IRC 351 will allow you to take that portfolio that has no more tax losses left. So the minute you sell, that's going to trigger a capital gain, right? What it does is allows you to transfer your portfolio into a newly converted exchange-traded fund that will then, because the exchange-traded fund, remember I talked about the 1031 being like kind? Inside the 1031, all stock transactions and transfers inside are like kind, so it doesn't trigger a capital gain. So I like it for folks that have maybe some concentrated positions, but there are some caveats to that. Would you want to hear what the caveats are?
Yeah, I want to hear all about this.
You can't have 100% of your money in Intel stock or Microsoft, and that's all you have. There's nothing we can do, okay? Too concentrated. So the rules are for transfers to an investment company like an ETF, the contributed portfolio must meet IRS diversification standards to qualify for tax-free treatment under Section IR 351E. These rules ensure the portfolio are not overly concentrated. So what is that? No single holding can exceed 25% of the portfolio's value. So if you had a big portfolio, no single holding can exceed 25% of the newly created entity's value.
Okay.
The top 5 holdings cannot collectively exceed 50% of the portfolio's value. And unfortunately, I had some people who were disqualified as a result of that. We do have identified one where, again, with all these other tax strategies I can combine those tax strategies, whether it's the oil and gas or some of the other things, to help offset the capital gain so that you would qualify for this IRC 351. So all those things I talked about before,
right,
I can use those as tools to help someone qualify for this. Why would they want to do this? I mean, it doesn't make any sense. They'd want to do it, A, to help diversify their portfolio. A lot of these, what I'll call non-qualified or non-tax sheltered accounts, brokerage accounts, they've been in these stocks forever. And I understand buy and hold is a good thing, but even Warren Buffett, he's a buy and hold guy, but he was very, very good at picking the right buy and holds. Some people are buy and holding stuff that's, it's time to sell and they can't because it's up, it's made a big gain and they don't want to get taxed. But they could be sitting in stocks that are no longer appropriate for their situation. They could be in companies that are no longer going to perform because when they bought them, they were a good deal, and that's not where the economy is going these days. So there's a lot of different reasons but it helps you the ability to create a newly modern type portfolio that you can be a little bit more active in without getting hit with big tax bills.
Mark, this sounds like a game changer for folks with concentrated portfolios. And since you mentioned ETFs, why do they have better tax treatments than mutual funds or, your traditional brokerage accounts? I've only got about 3 minutes left.
Well, I mean, again, I have to be very careful how I say this, but the mutual fund is what they call a 1940 Act. 40 Securities Act fund, and it's mutual. That means if you and I both put money in, let's say, Fidelity Contra Fund, you and I are both shareholders of Fidelity Contra. Now, unless it's in an IRA, what happens, Gary, is you might panic out of the market and sell. I might want to be buy and hold. If you sell and the fund is up for the year, they've got to redeem your shares, right? That's going to cause or let's say that fund is the mutual fund's doing lots of trading. The taxes get passed on to the mutual fund shareholders, okay, the unit people who own them. In an ETF, it's whatever you buy that ETF at. Let's say I buy it at 20 and it goes to 15. I've got a $5 capital gain. However, the ETF does not distribute because of the like-kind nature of how they buy and sell stocks and exchange shares back and forth. To keep it simple, again, high level, then they don't realize capital gains when they sell inside the ETF structure versus capital gains are passed on to individuals inside a mutual fund, which is one of the things that drives me crazy is people will inherit. Another thing you could do too is get the step up in basis. So when you inherit money, make sure you have your broker, your advisor, fill out the forms to step up that cost basis to the date of death of when that parent passed away.
Okay.
Because otherwise that will, because you, like I said, just like that old home, mom and dad bought that thing when it was $2 a share. Now it's 22. You're going to pay, if you sell that, you want your inheritance, you can't get at it. And by the way, for IRC 351, unfortunately, things like mutual funds, crypto, gold, they don't count. But other ETFs, stocks, and what they call separately managed accounts that all have tax traps do count towards that transaction.
I got 30 seconds. Wow, we got a lot here that you fit in 30 minutes here. Any last 30 seconds worth of advice?
Well, 30 seconds worth of advice is if you fall into this category, I have the pioneers of this product on speed dial. So if there's actually one that's going to be launching in June, the people who created this idea, there's been a couple of them done. I'm not going to name names, but I've been on the phone with them both. And I'm excited about it. And then one of my partners that I work very closely with is going to be launching one of these exchange-traded funds that you can transfer your portfolio in and get the tax treatment in. I would absolutely say most likely, there's no guarantees, but the manager of that fund is phenomenal. So give me a call. You got to get on my calendar, as otherwise I can't help you.
All right, so let's talk about that before we wrap things up. Financial Resources Group out of Glastonbury. Check them out online at www.frplan.com. By the way, while you're there, you can hook up with Mark's YouTube channel. Just when you get to YouTube, type in Mark Pappa, MarkPappa 5207. You can check out all of the, you can replay this show again or any portion of it or any of the previous shows that we have aired in the past. Or schedule that consultation with him as he just suggested. 860-657-8380. Again, 860-657-8380. For Mark Pappa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next weekend, have a good one, everybody. So long.